Hello, everyone. It's Steve with Aptera Owners Club. So if you are one of the people that are looking for feel-good news about Aptera and want to hear only good things, you might want to skip this video because um, this one might be a little bit pessimistic in some people's view. Also, if you don't like speculation, you should also skip this video because this is going to be nothing but speculation. And it's speculation by a person who really doesn't know anything. I have no special insider information about Aptera, and I'm not an investment professional. I'm not a financial analyst. I actually know very little about this stuff, and my track record is extremely bad. Okay, for example, Tesla. I thought about buying Tesla back around 2013, but when they were running at about $2 a share, I thought they were grossly overvalued and that they were not going to succeed. And so I did not buy Tesla. Obviously, a bad move. Also, I'm the guy that sold off Apple. I think I sold it in like 2004 or a little bit before 2004. They were selling for equivalent of like 50 cents a share at that time. I just thought they had nothing left and they were going to get smashed by Microsoft and that they were just not going to go anywhere and they would be a niche player forever. And so I sold them off at like 50 cents a share. So anyways, my track record is terrible. This is pure speculation from my part. But basically, today I wanted to make this video because one of our community members asked me to make a video about something that he saw in the annual report, and I think it's an interesting thing to talk about. So it's basically about how much money does Aptera need to raise, and this is again, I'm going to make some educated guesses on how much money they need to raise and how they plan on getting there. This may be completely wrong. But this is the part that he was wondering about. Right here in Aptera's annual report, it says the company plans to raise significantly more capital in future fundraising rounds, including offering equity at a significant discount to the price offered in this offering, which will result in dilution to investors in this offering. Aptera will need to raise additional funds to finance its operation or fund its business plan. Even if the company manages to raise subsequent financing or borrowing rounds, the terms of those borrowing rounds may be more favorable to new investors or creditors than to existing investors such as you. New equity investors could have greater rights to the financial resources compared to existing shareholders. Additional financing could also dilute your ownership stake potentially drastically. Specifically, the company has concurrent rounds open for shares of preferred stock, in some of which the share price is less than the shares currently offered as offering, which would dilute your interest in the company. Okay, so this was evidently very shocking to this person. And I personally, I don't think it's shocking at all. Like, this makes total sense. Aptera is going to have to raise money, lots of money. And that's just the nature of the business. And as the business changes, they may have to offer that in terms that give people a discounted stock or more ownership or more control, or if the company goes bankrupt, they get they're like first in line to get some of the assets of the company. Those are all things that could happen if Aptera becomes more desperate for money. Currently, Aptera is in a fairly good situation financially, so I think that they're not having to do that. But it says that they do have current rounds, some of which they're offering large investors stock at a lower price than the price that the crowd sharing is getting. So, you know, the price is $10.50 a share, and that's at a valuation of about $800 million. So Aptera is valuing themselves at $800 million. Now, why does Aptera need a lot of money? Well, it's because EV car companies burn through a lot of money. So according to the latest data, Lucid stock burned through $3.7 billion last year. Okay, so Lucid burned through $3.7 billion in a year. Fisker burned through $600 million in a year. Canoe, which is a pretty small operation, burned through $360 million in a year. Okay, so for reference, Aptera burned through $56 million last year. But these other companies, and Canoe's a pretty small operation, but when you start having production lines and things like that, you start burning through a lot of cash. I think Rivian burned through like $7 billion. So Aptera, Rivian burned through $7 billion last year. So these are the burn rates of EV startup companies. Rivian 7 billion, Lucid is 3.7 billion, Fisker is 600 million, and Canoo is 360 million. Now, it is a bit apples to oranges because these are full automobiles. They have a lot more regulatory, and the way regulatory hurdles that they have to pass, and their cars are much more complex to build. So Aptera has a lot of things going for it that they have less burn rate. But we can somewhat calculate what burn rate Aptera is going to need just from the information that we all have publicly. So we know that they burned through $56 million in 2023 and $62 million in 2022. And they're running pretty lean. So it's unlikely they can run leaner than that. So if you divide this, that comes out to about $4.5 million a month. Okay, so, and then they've said multiple times that they need $50 to $60 million. I think the latest figure was $55 million to get to tool up for the start of production. And that start of productions would start about 9 months after they got that funding. So you need $55 million. And then that doesn't take into account the burn rate. Okay, so let's say that someone wrote them a check for $55 million today. That's the best case scenario. And then you have 9 months of burn rate before production starts. So 4.5 times 9, that is $40 million plus $55 million. So that's $95 million that they have to raise from over the next 9 months, even if, okay, that's taking into account the $55 million that they got. So they would have to raise an additional $40 million over the 9 months just to take care of their burn rate. And then we know that they said that they would become revenue neutral at 6,000 vehicles a year. Okay, so 6,000 vehicles a year, which is amazing. That's an amazingly good number. So this is a really good best case scenario. So 6,000, and then let's assume that they mean the launch editions times 35,000. That's $210 million. So that means that if they make 6,000 vehicles, that can cover their costs. So we know that they're thinking around $210 million is going to be their burn rate per year while they're making these vehicles. If you add that to 95 million, that's about $300 million that they're going to have to raise over the course of the next 1 year and 9 months. Okay? That is a significant amount of money. They've raised a little over 100 million. And if you think about it, that is really, really cheap compared to the amount of money that these other EV companies have raised. If they're able to do this at $300 billion, they are the most capital efficient company that anyone's ever seen, basically, in the EV startup space. And even at that, you're going to need to raise $300 million. That's not a small amount of money unless they find a large investor. Like, Rivian had Walmart. Rivian had Amazon put a bunch of money into them. Canoo had Walmart put some money into them. They went IPO, and Aptera is going to have to go IPO at some point. And right now they're valuing themselves at $10 a share. Once they go IPO, the market is going to decide what the price is. Okay, so let's compare how various companies have been doing over the last several years by the market. The market has been brutal to EV stocks. Rivian has had basically a downhill trend over the past 2 years. Lucid, same thing. They went up. They peaked out in like 2021 at like $50, $60 a share, and now they're down at like 2. Fisker obviously doing horrible. I think the autofocus video really hurt them. But I mean, their cars were having software issues anyway. Now they're trading at like 5 cents a share. Canoe also not doing well. If you look at their 5-year max, they were up at like $400 a share at some point. Now they're like $3 a share. And think about Canoe. Canoe is a company that has actually 18,000 binding orders. These are commitments to buy it. People can't back out unless Canoe backs out. So these are binding orders of 18,000 stage 3 orders. They're worth about $750 million. And Canoe has delivered a few vehicles. We don't know exactly how many, but probably 30 to 50 to maybe 100 vehicles. They have delivered vehicles to the public. Mullen is another company. They make commercial vans. They are also not doing great. They were up at 300,000. They've had so many reverse splits that they were up at $300,000 a share. Now they're at $3 a share. That is horrible. But this is a company that has vehicles that they have delivered to customers, and they have a factory, and their stock is still doing that poorly. And so, looking at that, it's hard for people that are not fully invested in Aptera and understand the vision of it. And though a lot of us are going to say that Aptera cannot be compared to Canoe or Mullen or Lucid or Fisker or Rivian, because it's a totally different kind of vehicle. It's super efficient. It's solar. It's got a very efficient design in terms of how it's going to be made, and it's basically a revolutionary vehicle. And that's what Aptera is saying. That's the story that they're telling the investors, and that's probably true. But then the cynical investor is going to look at them and compare them to these other companies and say, hey, why should I think that your company is worth $800 billion when a company like Canoe that has binding orders and is actually delivering vehicles is worth only $178 million? Or Mullen Automotive, it has a factory, it's delivering vehicles. They're obviously having problems, but their market cap is $20 million. And there's a company like Rivian that's $8 billion, and they're going to say, is Aptera worth 1/10 of what Rivian is? Now, the people that see Aptera and understand its advantages are going to say, yes, absolutely it is. Aptera could be the next Tesla. And if you believe that, then this valuation totally makes sense. But if not, they're going to go after comparables. And that's how, stuff like real estate works. There is this 384 square foot, 1 bedroom, 1 bath house in the Bay Area that actually sold. This is a listing, but it sold for over 1.7 million. It sold for over the asking price. Because objectively, this thing is not worth that. But when people looked at it against its comparables in the area, they believed that was worth it. And then, then we got the other end of the scale. That there's these little towns in Italy that are selling homes for €1. Now, these homes are kind of ruins and not great, but they're €1. And obviously they're worth more than €1. Just the land and the bricks and whatever's left over there has got to be worth more than €1. But the comparables in the area, that's what makes this €1. That's the market price for it. And so when Aptera says that they may have to decrease the dilution, decrease the stock price and increase your dilution, that is a distinct possibility because they have to raise a minimum of $300 million. That, I think, that $300 million figure in my mind is a best case scenario. That's if everything goes smoothly, there's no setbacks. It takes exactly 9 months. They're able to ramp up to 6,000 in the first year, and just everything goes off without a hitch. And that seems very unlikely because nothing in this world works that smoothly. And my guess is they're going to have to raise closer to $500 million to $1 billion to really become financially solvent. And so that's the kind of money I think that they're going to be looking for. And to raise that kind of money, they're going to either have to go into debt. And if they do a lot of debt, then when they go IPO, which they're going to have to go IPO to raise that kind of money, then a company that has a lot of debt on its books is not going to look that great when they go IPO. So they are kind of they're this is the hard part of starting an EV company, and that's why, like, I really liked Canoe. They have a compelling vehicle. They they're having a hard time ramping production, and they're having a hard time finding money. These companies are failing not because their cars are terrible. Okay, maybe Fisker's, but like Lucid and Rivian, they make great cars, and they are producing them, but they're still looking for money. Rivian has been producing cars, and Lucid has been producing cars and selling them for 2 years, and they are still looking for money. They've been trying to raise money. Lucid fortunately has Saudi Arabia backing them, and those are some very deep pockets. Rivian is getting to a point where maybe they're selling enough vehicles to become solvent, but they're having to find money for 2 years after they started production. And so Aptera is going to probably be in the same boat, unless their production model is that much more efficient. And of course, they're going to be more efficient because, I mean, they can't afford to burn through $7 billion like Rivian did, or $3.7 billion like Lucid did. They have to be able to burn less than Canoe did at $360 million a year. And I think they've calculated their burn rate to be like $200 million a year. And if that's true, they're doing very, very well. And at that rate, they are going to have to raise minimum of $300 million a year, probably $500 million a year. And if things don't go perfectly smoothly, which I don't think they will, they're going to have to raise about $1 billion a year. That's just my guess. Let me know if you think I'm crazy in the comments below. Thanks for watching, guys. Have a great day.